Welcome back. This morning, U.S. President-elect Donald Trump was named Time Magazine's Person of the Year for a second time. He's speaking right now at the New York Stock Exchange. There's a live look at the New York Stock Exchange, and he will be ringing the opening bells at the New York Stock Exchange at 9:30 a.m. Eastern Time. We'll have that for you as well. So something interesting going on today at the New York Stock Exchange market site. In the meantime, we're back with Lyle Stein. He's president of Forvest Global, this time to talk about markets in 2025. And you've given us your view of the setup. Not only do you think Canada is a lackluster economic environment, but you see that a lot around the world, except in the United States, and there the issue is equity valuations, correct?
Exactly. It's been the only place to be. And, the question is, does this really one-way trade change in 2025? We've just gone through 2 years of 20% rates of return. That's only happened 4 or 5 times in the last 160 years.
Yeah.
The following year was only up once, sometime in the mid-90s. What are we going to do for an encore? Right now, everybody's focus is on how much money can I make? Where can I make the best return? In that kind of environment, sometimes it's good to look at the other side, is where do I avoid the loss? And so I think 2025 is going to be a year where you want to avoid the torpedoes. Mm-hmm. And, it's amazing, even though the big cap tech names continue to dominate, we've had 2 software blowups just this past week. We've had Adobe and then somebody on Monday, we didn't own the stock, fortunately. Mm-hmm. The healthcare companies, yesterday we had big losses in CVS and United Health. When people sell, they sell with abandon, and who's there to pick up the pieces? So what we're looking at is how do we control the risk in our client portfolios, as opposed to how do we want to maximize the exposure to this group or that group.
Right.
By default, we're diversifying. Diversifying means you'll never beat the top group, but at the end of the day, you have your capital, because the return of your capital is more important many times than the return on your capital.
What sections of the equity market do you like from a dividend-paying point of view?
Well, we talked earlier about the Canadian energy names. We think those are very favorable. The fact of the matter is oil prices are low, gas prices are at almost record lows, and we don't see that staying. The beauty of a low commodity price is it corrects itself. Mm-hmm. Nobody drills, nobody explores. We're seeing a slowdown in gas drilling, which is good over the next few years for prices to rise. We have great companies in Canada. We've got great gas supply. That's an area where we think it is appropriate. Pipeline companies, same thing. We've added to Enbridge and TRAP, the South Bow, which was spun out of TransCanada. We actually added to our position.
So that's Enbridge TC Energy, which is what I think you're referring to as TRAP.
Yes.
TC Energy. And South Bow is the recent spin-off from TC Energy.
Yeah, also known as Keystone.
Right.
These are energy movers. We've got Mr. Trump talking about how he wants to make energy great in the U.S. again. We will benefit from that. So that's an area for dividends and dividend growth.
And on the energy stocks, on the energy producers, a lot of them are emphasizing share buybacks in addition to dividends, regular dividends and quarterly dividends. Do you view share buybacks favorably as well? Does this fit into your picture?
It does, because it's returning money to shareholders, whether it comes in the form of a dividend. Bird in the hand's always nice, but the reality is a share buyback is the next best thing. Is really, really close. You look at the metal companies, our gold companies. I met with the management team of Agnico Eagle last week, and at the beginning of 2024, they had $1 billion+ in debt, and they're going to be out of debt by the end of the year. Mm-hmm. This is happening right across the spectrum. These companies are much better managed than they've been, and their products are denominated in U.S. dollars, and many of their costs are Canadian dollars.
They're not big dividend payers, though. The gold miners.
They've committed to using the newly discovered capital that they're earning to return to shareholders. That's a real positive. And so we're seeing dividend growth. And frankly, some of these metals companies, gold companies, are yielding more than the S&P 500. So again, where is the risk in the portfolio? Well, is an accident. And where you're going to get an accident, you're getting an accident in a high multiple stock, not necessarily a high dividend stock, unless the high dividend stock cuts their dividends. So that's why we don't own the Canadian telcos.
Why don't you own the Canadian banks, though? Among the big five, there's never been a dividend cut in the big five.
I'm not worried about dividend cuts. I'm worried more about dividend growth.
Okay.
And, you look at the experience of TD Bank, they're not going to raise their dividend. Or if they do, that'll come as quite a shock, but then they're not going to be able to grow. The banks, I think, will not be the dividend growers. They have been because of their tie to a lackluster Canadian economy. They are the purveyors of credit, and we've just gone through a 40-year credit cycle. I think the better opportunity in the banking sector is still south of the border.
As a Canadian portfolio manager, do you invest south of the border in dividend-paying stocks because the dividend income doesn't get treated as favorably by the tax authorities here in Canada? That's
correct.
Right.
But that said, when we bought Huntington Bank at the depths of the junior bank crisis, we were getting a higher yield after the 15% withholding that you get on a Canadian bank stock. So when an opportunity presents itself, we will look for a dividend, but we have to recognize the withholding tax impact.
What about the Canadian life cos, also big dividend payers?
Interesting. We unfortunately didn't catch the rally this year. I would much prefer a Canadian life co to a Canadian bank in this current environment because one of the, I think the downfalls in Canada will be our real estate sector. It's starting to crack. And lower interest rates are a plus in the near term, but we've got some major issues that need to be resolved with respect to affordability. And that, I think, is going to put pressure on financials in Canada, not so much the life cos.